And so we're happy to have our monthly Meet the Lenders webinar, which is always a great opportunity to kind of recap and kind of meet again some good lenders that are out there and understand what's out there for the small business community. My name is Danny Fitzgerald. I'm with the San Diego and Imperial Small Business Development Center Network. We, of course, are here to be able to help you, the small business owner, kind of navigate the capital markets, the lending process, starting your business, running your business, marketing your business, et cetera, et cetera. We are funded by the U.S. Small Business Administration and the State of California Office of the Small Business Advocate, among with a number of other funders, and that allows us to be able to provide the services at no cost to you. We have a team of over 120 expert advisors here in the region that are able to provide one-on-one advising, and in particular, also some fantastic experts on lending, capital, and so forth. So we also appreciate our sponsors for this event. That includes CDC Small Business Finance, Marble Bridge Funding, United Midwest Savings, Pacific Premier, LendSpark, Primary Funding, Founders First Capital, Civic Communities, and Banner Bank. But first we want to kick off and allow our partner at the local SBA district office, Lucy Montgomery, to give us some updates from the SBA. Lucy.
Hi, thank you so much. I have now shared my screen, so hopefully you can see that. I just wanted to say happy SBDC Day to you at the SBDC, which is coming up on the Ides of March, I believe. The SBA, and it's particularly our local office in San Diego, want you to know that our local SBA has been recognized as one of the best in the nation. And we really encourage you to get some information and some help from your local SBDC. I have some interesting news about EIDL, if you happen to have an EIDL loan. So I have a little update here. We have a new, more user-friendly portal, thank goodness, my SBA loan portal that you can get to by going to www.lending.sba.gov. Still, if you need additional assistance on this, please go call the disaster customer service at 833-853-5638. And I have that right here on that slide. Hopefully you can take a look. That's if it's time to start paying your EIDL loan. For most borrowers that borrowed in the early months, your payments are now due. This is what this My Portal looks like, and you can see it's a vast improvement and includes like interest and payoffs and lots of information. You can make one-time payments on your loan now. We suspect that you'll be able to make recurring payments on this platform probably in the next 30 days. That will be available to you. We're kind of building the ship here, but it's getting better, and I hope this is helpful to you. Now, in general, you're here because you need additional capital, and you need additional capital. That's where SBA comes in, but it's a little different than you might imagine. So I'm just going to go through how SBA helps you start, grow, expand, recover. How can the SBA help you get this capital? Well, the SBA helps with SBA-backed loans, private investors through, there's an SBDC Connect and the Brink, which can help you with that. Research and development, and we can help you with surety bonds. Here we're talking about SBA guaranteed loans. And so this is how it works. You will go to the SBA's lending partner to get the loan, and then that'll go right to your small business. You don't need to go to the SBA directly. So the SBA works with these approved lenders and uses what's called a loan guarantee. We back these loans, and that allows the lender to give more competitive terms, lower down payments, flexible overhead, and you can be provided counseling and education. So you can use these loans for a variety of things depending on the type of loan, launch, grow, repair, working capital, purchase inventory. You can even use them for exporting, which we take a look at that. That's coming up and increasing. You can also purchase land or real estate. The types of SBA loans for purchasing real estate or commercial properties, 504. 7A is our flagship. This is for your working capital, or a micro loan, which is $50,000 or less. We also have a couple of different varieties of these 7A loans, including that export loan I was talking about. These are the regular SBA programs. These are available through their lender. Now, in the case of a disaster of this stormy rain cloud, et cetera, major disasters, the SBA does loan directly, which is our economic injury disaster loan, which you might be familiar with from COVID. You can go directly to find a lender using the web. You can go to our lender match if you like, and find an SBA approved lender. But we recommend you use one of our local resource partners to help you develop your business plan, your expense sheets, your financial statements, and your projections. And on this call right now, these lenders are going to help you determine what you need specifically for them to get these loans. We have local resources and assistance all over the country and the state. And the SBDC itself has multiple offices right here in the county. These are the sponsored SBA resource partners. And today we're highlighting, because it's SBDC Day, right here, your SBDC. There is the website. Click on it. If you have not found an advisor and become a member so you can get the information, do it now. Copy that down, take a picture. I guarantee that they will help your business. Thank you. And I just wanted to give this real quick update, and I appreciate your time. And again, on the Ides of March, it looks like there is an SBDC Day procurement event. So if you want to sell to the government, attend that event. I think it's in person, if that's right, Danny. Thank you so much. And pay attention, because there's lots of changes in the banking, and you'll need to know. Have a great day, everyone.
Thanks, Lucy. And yes, on so SBDC Day is March 15th. This is when we celebrate actually the anniversary of the signing of the act that created the SBDCs. We've been around now for over 40 years and proud to continue to be able to serve you and do that. And so the event is actually specifically on selling to the state of California. So the Department of General Services will be there. You can find the links on our website and be able to sign up. And Marisa, who's of course on it, just was able to post that link in the chat box. All right, well, we'll go ahead and move on to our fantastic panel we have today. And so want to be able to give them a chance to introduce themselves and be able to talk, and their bank, and then we'll start going through some particular questions. Why don't we go ahead and start with you, Andrew?
All right, good morning, everyone. I'm Andrew Crone. I'm Senior VP, Marble Bridge Funding Group. We are a commercial finance company located in Northern California. We lend throughout the state of California and throughout the U.S. We specialize in receivable finance. So we fund receivables, purchase order, contract finance. And we've been around 24 years. I've been doing this 22 years. And we deal with businesses specifically, our B2B or B2G. They are businesses that provide a product or service to another business, or they provide a product or service to the government, and they invoice them and they're waiting to get paid 30, 60, 90 days. And they want to turn that into cash immediately. And that's what we do. Thank you.
Thanks, Andrew. Pete.
Hi, I'm Peter Tirado, Banner Bank. I'm the branch manager of the Carlsbad branch. Been in banking and finance for about 18 years. Banner Bank is a community bank that actually specializes a lot with working with small businesses, whether they're looking to get, short-term capital, for, payroll, marketing, any type of line of credit needs, or if they're looking to either a business acquisition, purchasing equipment, updating their equipment, whatever their needs are, we can assist small businesses with any type of loan needs. We also do provide commercial real estate, owner-occupied and non-owner-occupied as well, for business owners. So, Peter Tirado, Banner Bank.
Awesome. Thank you. Juliet.
Good morning, everybody. My name is Juliet. I work as a business development officer here in San Diego for Accessity, and we are a micro lending organization. We are a certified CDFI, which is a community development financial institution, and we do term loans up to $100,000 for both startup and existing businesses. We are based in San Diego. We've been around since 1994, but we do service Riverside, San Bernardino, of course, San Diego, Imperial counties, and then we just expanded up to LA and Orange County about a year ago. So we're really serving the Southern California region, providing term loans, again, up to $100,000. Thank you.
Fernando.
Good morning, Fernando Ponce with Primary Funding. So we are just like very much like Andrew, an asset-based lender. We provide factoring, purchase order finance, some bridge loans and lines of credit. We also do some brokering and work with a lot of smaller community banks to provide SBA and Cal Southern loans.
And Janelle. You're on mute, Janelle. Let's see.
There you go. Can you hear me?
Gotcha.
Okay. Yeah, I'm working on my phone, and sometimes the mute button's a little hard to find. I'm Janelle Shalou. I'm a business relationship manager here at Chase Bank. Chase Bank is a traditional bank, is the largest bank in the country. We do have a pretty small credit box. So our best clients are usually businesses that have been in existence for at least 2 years. But what we do really well. I mean, we do any type of lending. We start at 10,000 and we can go up to, in my group, up to 10 million. We do lines of credit right now if you have tier 1 credit without any financials. So we're really helping a lot of our small business clients get financing based solely on their credit. I've been in banking for about 20 years and been with Chase for 2.5 years.
Awesome. And continuing kind of along the nuts and bolts of things, we'll go with the question of kind of how a small business would, work with you as a lender to be able to acquire a loan, and kind of, what that particular process works, and who would be really kind of the ideal small business, like, time in business and things like that. So why don't we go ahead and start with you, Pete, on that question.
Okay, so I would say, if the client's wanting to get funding, obviously, talk to your SBDC. but with us, what I'd really want to do is first get to just know the business. When it comes to submitting an application, your underwriter, you want to be able to paint the picture and help them understand the borrowing cost. So I would want to understand things about, what your business looks like, what do you do. Credit score it's really going to be case by case, because we have helped clients that have had lower credit scores per se, but as long as we can provide an explanation of what that is for a legit reason, we can get by that. Years in business, I think one of the nice things with Banner is we can actually help startup companies. I've helped quite a bit of them, so we don't require a 1 year, 2 year in business. We probably would want to have some type of business plan together, some projections, and then just have some type of guarantor strength, whether that's a secondary income coming in, maybe some collateral that you can pledge as well. But yeah, I would say the biggest thing is just come honest and come ready to provide us all your information needed, so that once we submit a package, we can present a strong case for you.
Thanks, Pete. Fernando, what about you?
Yeah, so we're really looking to be a bridge to the bank, right? So we're working with companies that either are not quite bankable, or maybe were bankable at one time and fallen on maybe some harder times and have lost the ability to obtain bank financing. So personal credit isn't really a driver for us for the most part. We're really looking at who you do business with, what kind of contracts you have with them, what kind of volume you're doing with them, and is it going to be reoccurring, right? Because we're really underwriting to the strength of who you're selling to at the end of the day. So for us, if you're in a B2B industry, if you get paid on net terms of 30 or 60 days typically, and you just really need a bridge between that time from when you invoice and when you get paid, that's where we're a great bridge lender to come in and provide financing on those specific invoices to get you the cash you need to cover your overhead or pay your vendors or your suppliers. And then on the front end of that, we can also do some PO financing where you actually haven't completed the service yet, but you need a little bit of cash up front to buy a product or procure a product to send to the end user. Or a retailer. And so as long as the contracts or the companies that you're selling to are of good sound quality, and we can underwrite to that, those are the clients that we're going to have the most success with, even if you have some maybe some cash flow issues or some credit issues on the personal side.
What about you, Janelle?
So we are a traditional bank. So our requirements are a little different than some of the others on the panel. We are looking for at least 1 year of tax returns in order to do financing. We look at historical performance. So we're looking at your past revenues. We're also looking at your credit. So I think we would be, perfect for somebody that's already started the business but is looking for additional capital to grow the business. And again, as I said, we do have a line of credit and term loan programs. If you do have Tier 1 credit and have a great relationship with Chase Bank, we are able to submit the loans without any financials, based solely on your personal credit. So it's a good opportunity for people that are in, the 1 to 2 year range that don't have the strong financials yet. But we are offering that for our clients.
And Juliet.
So I always say that the best way of starting with our organization with Accessity is to have a conversation with somebody on our business development team, right? And so that would be me here for San Diego. And just to see if you'd be a good fit for our program. So what we do is we look at all of your strengths and weaknesses as a borrower. So with credit score, we're not really looking for a certain score. It's more important what's reflecting on your credit. And then we do work with pure startup businesses. So if you're a pre-revenue generating business, it's important that you have another source of income, whether that's a job that you have or somebody who can co-sign on the loan or a spouse who works. Even if it's a side hustle and you get paid for that, we can use that as another source of income. So that's what we're looking for on the income side. We really just want to make sure that this is a debt that you're going to be able to afford to pay. And these are all the things that we'll cover in that first introductory call of about 10 to 15 minutes just to see if you'd be a good fit for our program. And then we also look at collateral. We can use any sort of vehicles. They can be trucks, trailers, food trucks, personal cars, third-party cars as collateral on the loan, although it is not required for any loan size. So we do loans up to $100,000, but it's not required to use the collateral. So don't count yourself out if you're saying, oh, I don't have a car to use as collateral. That's perfectly fine. It's just another strength that we can add to your loan package. So again, that first 15-minute call with me, I can help you identify those strengths and weaknesses to see if you'd be a good fit for our program. But kind of like Fernando said as well, we're also working with businesses that aren't quite ready to go to a bank or a traditional lender right now. So we work with those pure startups or somebody who's 1 year in business or just not quite meeting the requirements of a bank yet, even if they do meet the time in business requirement. Yeah, so that's how we're looking at deals. But yeah, that conversation with me at the beginning is going to be really helpful.
Thank you. And Andrew.
So for Marble Bridge Funding Group, we're working with clients from startup, and I mean startup, they're going to have revenue probably in a couple of months, so we can sign them up early and get them ready for receivable finance. The clients are about 50, 60 million a year in revenue. Now, most of the businesses we see are revenue around 500,000 to 20 million. They come to us because they're growing. So the clients we see are growing. They may have had issues in the past. They may have had losses. They've turned it around. Maybe they don't fit the banking model, or maybe they do fit the banking model, but the bank's not going to give them enough money. So, but the key thing among all the clients we deal with is they have a potential to grow and grow very rapidly. The underwriting, I gather, and I'm the one who does the underwriting. So anyone who talks to me, usually within a phone call, I can figure out whether I can fund it or not. So we make the decision very, very fast. Of course, afterwards, we'll gather financials, tax returns, and all the usual stuff that most financial institutions do to make sure you're on track. We'll make recommendations if we see things we can do to help improve your business. And we're a bridge, same concept as Fernando. We're getting you from point A to point B. I have companies who have gone with me at 2 million in revenue and jumped to 5 million within a year. At that stage, they're done with us and they move on to traditional bank financing. A lot of clients we talk to come from SBDC, who is able to determine from their analysis whether they're bankable or not, or where they fit in. I have clients that have 800 credit scores, and I've done clients with 500 credit scores. So from an underwriting point of view, we're probably very, very liberal on that side. And if we got everything we need, we can get the deal done and signed and funded in under 10 working days. So we move very, very quickly. And final aspects to all that, And important for everyone that California has new disclosure laws from lenders. And so you should be aware of that, especially if you're looking at some of what I call the vulture capital loans that you've seen online, MCA lenders and such. Everybody has to have a disclosure now, or they're not meeting California law. We're all set up with that. Our docs have been updated to that. And finally, we could do up to $5 million a month in funding. Most small businesses I deal with don't need that much money, but you know, they come in here and they have 300,000 receivables, 500, $1 million. We bring them in, we say, go get the business. We'll help you fund it. Okay.
Thank you. So a question I have for everyone on this next one too is, of course, we're all aware of the raising interest rates and kind of the economic pressures that are now. And how is your institution or organization adapting or seeing small businesses adapt based upon kind of some of those economic indicators that are out there? Fernando, why don't we go ahead and start with you?
Yeah, you know, for us, it hasn't been quite that big of a factor. The rate increases, you know, the way we're fee based, right? So we take a percentage of the invoice. So for the most part, hasn't impacted us too much. We've, you know, maybe increased it a fraction of a percent here and there when needed. But I have seen it affect, you know, a lot of the existing bank loans. Unfortunately, I was talking earlier to a few of the people on the panel that, you know, we've been seeing more workouts now than before in recent years. And that's when a bank and a borrower, you know, unfortunately the relationship sours. And that could be due to, you know, financial performance of the borrower. It could be just lender fatigue sometimes, you know, that, you know, they just, you know, kind of grow apart as far as the business philosophy and where the bank is. So I think the rates have definitely affected that as well, because, you know, you go in and maybe this was a facility that was put in place, you know, when rates were in the low threes, and now, you know, if it's coming up for renewal and suddenly, you know, you're at a 6 or 7% rate. And there's been some financial stress, you know, over the past couple of years due to COVID and everything. Now suddenly you don't cash flow, you know, the way you used to for those loans, even if they were stress tested at a certain, you know, percentage. And now we're above, you know, it would have been fine at the previous cash flow, but now with cash flows being a little bit less than what they were. So we are seeing that a lot of businesses are getting, unfortunately, a little bit stressed. And then also just the amount of capital out there, I think, you know, that is probably the bigger impact than the rate, right? The rate is one thing, but there is just less money. There are less loans being done. It's harder to qualify. And so I think just the capital markets drying up is probably the more impactful thing than the rate itself.
Thank you. And Juliet, what about at Accessity?
So the good thing about our organization is our rates are actually fixed. So they're not going to fluctuate with the market. We always offer a 6.99 to 14.99 range. And you're probably thinking that's a really wide range. And it is, but what we do in that initial conversation is give you a quote for that, for your potential interest rate. So that's not something that's affected us. I think more what we're seeing is a lot more of, I think Andrew touched on it, the predatory loans, right? The MCAs, the high interest loans, the weekly, daily payments. So we're seeing more of that. And we're seeing more usage of credit cards for small businesses. So I would say that's how the economy is currently impacting small businesses. Now in our underwriting, we're trying to take that into consideration, right? But I think as Fernando touched on it, you know, as you build up your balance on your credit card, your minimum payments increase, right? And so that has an effect on your cash flow, especially with the size of businesses that we're working with, right? They're not $1 million businesses, you know, they're making a couple $100,000 a year, if that. You know, I have a client that's making $50,000 a year. So it's really having more of an impact, I would say, on the amount of capital that's being used, that they already have available. And that's what we're seeing. So we're really trying currently in our underwriting process to take that into consideration and see how we can make things work, or, you know, if we can approve them for a smaller loan size so they don't have as much of a payment monthly on top of their other monthly payments.
Thank you. And Janelle.
So I agree with a lot of the things that the panelists have said. Here at Chase, I've seen actually an uptick in loans. I think we've been very proactive in reaching out to our business clients and letting them know that now's the time to get emergency funds, lines of credit in place, really talking through their financial situations. We are seeing clients that, started off with another institution or bank with a variable rate loan that are coming to us, to fix it just because the rates have increased, with prime climbing as high as it has. But we are still doing, quite a few loans. I have, pretty full pipeline. Loans are getting approved, so the only thing I would say is we do have some loans that are kind of, in default, but those are the clients that I think, were on shaky ground before, the situation now with the economy. And so that's sort of the tipping point for them. But for the most part, we are still actively pursuing and lending to our clients.
Fantastic. Andrew.
Yeah, so as far as the interest rate environment, I have a couple of things to say. As far as our lending goes, we have not touched our rates at all. They remain the same that they've been for years. The cost of money, as far as the money we get in, has gone up from the bank significantly, but we haven't passed any of that on to our clients. That being said, I think the most important thing to get out of this inflationary environment we're in today is businesses have to be able to raise their rates and pass on the cost of labor and materials. And it is not stopping. It won't be stopping for the foreseeable future. You have to have pricing power. I know I've seen a lot of businesses that were afraid to raise rates because they're afraid that they were going to lose customers. But the reality is everybody is doing it. Just go to the supermarket, just have a meal out for lunch and spend $50, or an $18 hamburger now. I mean, so everybody's passing it along, and you got to do it as well in order to survive your business. If you can't increase rates, you're not going to make it in this environment. From our underwriting side, nothing has changed, but I could say the amount of flow coming in, and I'm sure Fernando's seeing the same thing. He brought it up once before. We're seeing a lot more distressed businesses. So businesses are being referred into us that don't even fit our underwriting standards, which are very, very liberal. They really have a lot of problems. A number of them really got through COVID with PPP, got idle. Some are still getting ERC, employment retention credit, which you hear about on radio ads every day to try to get that in. And the businesses we've seen, a number of them got all that money. So they sort of survived it. Some of them, though, even with the money, have not been able to survive it. Some are experiencing losses due to the economy. I talked to a general contractor yesterday that did about 14 million a year in revenue, and he took a $3 million hit last year. One of the buildings he completed just didn't pay. It's an office building. Nobody's going to get in there because no one's in the office buildings, and it was over. And now he's just trying to survive with all the debt he has that he spent, with the suppliers and everything. And he's going for predatory loans. I can see that. We talked about it, and that's not going to help him at all. And there was no way for me to help him either because he was in such tough shape. So he had a good 10-year run, and now he has some major challenges. So the environment is going to be tougher. Banks are going to be tightening up. They are tightening up, and their box is getting smaller. Our box stays the same. And in this environment, as always, we find businesses that are young, that are new, that are growing rapidly, that can't get enough money from traditional lenders. I found one last week. He left his company, left who he worked for 20 years, started his own company, worked in 7 months, got 700,000 in revenue. And this year he thinks he could do 2.5 million. And the opportunities are there, and he's coming on board with us. And the local bankers know him, but he's too young for them to come in and fund yet. So we're going to pick up that slack. And he was very excited to find us. So the right fit for the right lender. There's a lot of different lenders here. We all have different specialties, and you should talk to all of us. That's it.
Thanks, Andrew. What about you, Pete? What about at Banner? How's that changing?
I haven't, it's pretty similar, I would say, to Janelle. We haven't seen any downtick as far as people wanting to get funding. I think because rates are raising, clients have wanted to come in before they go any higher. So, you have a lot of clients just doing that out of fear. From an underwriting perspective, I would say the biggest thing that I've really seen as a shift is when it comes to high revolving debt from an underwriter's perspective. Looking at that because, in the past, that really was never a big deal, but now, especially in the rate environment and the economic, factors, they're looking at that a lot more because it could have, red flags to a cash flow issue, where clients are, having to use credit cards to stay afloat. And so for us to be able to provide additional financing, even if it's a debt consolidation, sometimes they're giving a lot more pushback now because we don't, especially if there's collateral loans, we don't ever want to put our customers in a position where, hey, we're gonna have to default on your loan and take your vehicle or take your home. Like, we're not in the business of selling real estate and vehicles. So, we really want to make sure that we're educating our clients a little bit more. Again, getting that information up front, because if I know that from the get-go, it's like, let's put together a plan first to be able to maybe address some of those weaknesses so we can get you a better chance of getting approved. So always be upfront, when talking to your financier, letting them know everything about your finances, because we're going to know anyway, but if it's too late, it's always hard to backpedal with an underwriter as opposed to addressing it at the get-go. So I would say that that's really the biggest thing that I'm seeing.
Fantastic. Thank you. So now I'm going to kind of go around the horn with just kind of some one-off questions for each of you for kind of some explanations or kind of some education for our folks. And I'm actually going to start with Juliet. We have what's called in California State Loan Guarantee Program. What is that and how does it work? Because I know Accessity is a major user of that.
Yeah, absolutely. So essentially, the way I describe it to clients is that we have our loans guaranteed with the state of California, as you mentioned, rather than the SBA. And the way I say it to clients is that if they were to run away and never pay us, we can get paid back up to 80% of that loan. So essentially, it's a program where the lender can be insured that if the borrower doesn't pay, there is some sort of guarantee, right? Because a business loan is essentially an unsecured loan. We can use the collateral that I mentioned, the paid off cars, but because it's not required, we have a lot of loans that go out that are unsecured. So essentially we're giving you money with, the hopes that you'll pay it back based on the underwriting process. So the state guarantee program allows us to have a little bit more confidence in the clients that we're lending to, especially because we are lending to startup businesses. So businesses that have absolutely no history of repaying any sort of loan or business loan. So it gives us that security to be able to take more risk, I would say. And, that is really what sets us apart from a traditional lender like a bank, is we are able to take that risk because we have this state loan guarantee.
Fantastic. And I know a lot of banks use the SBA guarantee. And Janelle, could you explain the SBA loan guarantee?
I guess the SBA guarantee mitigates the risk for the banks. So if a client comes to us and applies for a loan, we try to get the approval through conventional means, saying that Chase would do the loan for them. If there's a little more riskier loan, say length of time in business, your balances aren't there, you don't quite have the cash flow available, what we do is we reach out to the SBA, and the SBA provides a guarantee. And so what the SBA is saying is that if you default on the loan, that they'll pay up to 85% of the loan back to Chase. So it gives us peace of mind, or more peace of mind, knowing that there's a guarantee in place in case there are some credit issues or some payment issues coming forward. So basically, Chase does the loan, and the SBA on the backside, will cover the risk. That being said, you still need to make payments. It's not a guarantee that if you don't pay the loan, the SBA will just pick it up, because Chase will pursue you for the loan because you're still defaulting for a loan with Chase, and the SBA will come after you as well. So it's not saying that you don't have to pay the loan back. It just helps our credit decision and allowing us to give loans to people that might not qualify through the traditional lending process here at Chase.
Fantastic. So in short, a guarantee kind of works like insurance for the lender.
Right,
That's
exactly.
the way to kind of think of it.
Uh-huh.
All right. So we've also talked about different kinds of loans. And so Pete, I'm going to ask you if you could explain the difference between a line of credit, an unsecured loan, and a collateralized loan.
So a line of credit, first of all, you want to think of it more for short-term use, right? So I know a lot of times, clients could come in and say, hey, I want to take out like $500,000 for a line of credit so I can get some equipment and things like that. It's like, well, a line of credit, you're typically only paying interest only. So to make it really easy, think of a line of credit like your credit card. That's what it is, right? It's a line of credit. So when you talk about unsecured, again, a credit card is an unsecured type of line of credit. When you're securing a line of credit with collateral, that could be, equipment, that could be a vehicle, that could be real estate. There are things that you pledge. Now, typically when you pledge collateral, you get some more favorable terms on a line of credit or a loan. So you can get a longer, term, you can get lower rates because since it is, the risk is mitigated with the collateral, you can get better pricing. So a lot of times people will like to do collateral for the sake of getting a better rate. But when you're thinking of a line of credit as opposed to a term loan, you're thinking short-term funds. So if I need funds to be able to cover payroll or to cover, bridge a cash flow gap, that's what a line of credit's really going to be for, is for that short term. I'm going to pay it back 30, 45, 60, 90 days and pay it back. I have that for short term. Then when you go to term loans, that's where you're thinking anything more than a year, where you're paying it back over time with principal and interest. So that's really kind of the difference between the line of credit and term loan, is you're thinking short term versus long term. And again, I don't want to have a $500,000 line of credit that I've paid interest only for 5 years and the balance hasn't gone down. You know what I mean? So different purposes for each.
Fantastic. Those just good to kind of understand those. And then Fernando, you all deal with a different type of lending, invoice financing. Can you explain what that is?
Yeah, absolutely. So essentially what we're doing is we are buying invoices at a discount, right? So you've completed work, you are now submitting an invoice to get paid. They're going to pay you, let's say on net 30 terms, right? So in 30 days. So you don't have the ability to wait for that money to come in. You have to pay your vendor, you have to pay your employees. And so what we do is we take that invoice, if we've already vetted out your customer, vetted out the contract, make sure that we can actually have payment redirected to us on that invoice. And now we can collateralize that because, it's coming to us, right? So you submit the invoice, we just verify that the work is complete, and we advance typically around 80% of whatever the face value of the invoice is. You have that money now to do whatever you need to do with. We will sit on it and wait. When it pays and within that 30-day time frame, we then discount our fee, which is typically, let's say 2.5% of whatever the face amount value of the invoice is. And then whatever the balance is left over, that residual, we give back to you in a reserve release, right? And so we're able to do that over and over again. And it works very similar to a line of credit in that respect, because you're able to, if you have a bunch of invoice, if it's 100,000, if it's 50,000, whatever that is, you could submit that to us and we can continue to give you capital and revolve that. And then when the contract's up and you no longer have a financing need for that, it's done, right? We can move on to a different client. We can do multiple clients at one time. But it's really a great tool to scale with you up and down. So if you have a lot of seasonality in your business, what we've seen with like lines of credit, what Peter was talking about, right, is a lot of times clients don't have very good discipline in how they use that money, right? So they'll use it, max it out, and then just pay the minimum. And then as they get paid, instead of paying it down, they just pay the minimum interest. Well, the factoring program really helps you to revolve that as it comes through, because we're receiving the payments, paying that down as it goes. And so you're really never in debt, right? You're really just using it as a cash flow tool.
Fantastic. And then Andrew, you talked earlier about these predatory lendings, MCAs, things like that. What are these, and can you explain them in a better way and how to avoid not taking them out?
So this merchant cash advance, as it's more commonly called, sometimes we call it fintechs, but they're all over the country. A lot of them are based on the East Coast, and they're generally private equity funded. And they have, some of them have grown in very, very big ways with billions and billions of dollars being lent out. So generally the way the model seems to work is they reach out to you by email, by phone, by postcard, however they get to you. And you probably, anyone in small business is being inundated because you can buy lists of small business anywhere. And they have budgets to go ahead and do that. And they also use brokers and other people who get commissions off these things. But the biggest key part about them, they're very high interest rates, usually, minimum of 15, usually 20%. And if you pay them off early, then you're going to be looking at 30 or 40%. And so a lot of them don't really explain it except to say, hey, you need $100,000. Call us, we'll get you the money 24 to 48 hours. They may pull the credit, they may get some tax returns, and they have some kind of internal formula that's really simple for them to figure out risk. A lot of the loans are paid back, and here's what the problem is, over 9 months. Sometimes it's a year. And they break even somewhere around 3 to 6 months into it. So, and what they do is they have direct access to your bank account. And that means that they give you 100,000, they may charge you couple of points, so maybe you get 90,000, 95,000 of that money, and then every week, it could be daily or it could be weekly. A lot of them are weekly. They're going to take out $800, 1,000, 2,000 out of your bank account. So in the beginning, you look rich and you got some working capital, but as the months go by, they start draining it out pretty quickly. And then usually with most businesses, if you can't make it in profit, what they're charging you, you're going to do what a lot of businesses end up doing, is being addicted to this type of money, and they take out another loan. And sometimes, all right, the first loan was 50, the next one's going to be 75, and they get buried. Or they end up running to other lenders in the same field, which they call stacking in industry. And I just helped a client that had 10 of these loans, 10 of them, if you can believe it. He was headed to bankruptcy. It was just, getting money in and paying the other lender and trying to keep the ball up in the air because some things had happened to them. So they're usually not good at all unless you really know you can pay this thing off very quickly, get in and get out. And so within the United States, I'm aware of New York and New Jersey and now California have enacted disclosure laws to help small businesses. So many of them were hit up by this. And one of the things that can happen is if you miss a payment to these guys or they discover you're not doing your thing, they just raid your bank account and grab everything. It's a pretty scary process when you give them the keys to your bank account. And so some of them, that was their modus operandi. They were looking for you to make one mistake and then do it. And you get charged with 60% interest or 80% or whatever it ended up. So state of California, for those of you, I'm sure everyone here is in California, they've enacted lender laws now. They started 2 years ago. They're working with people in my industry, working with the MCA lenders, working with PayPal, a lot of players who are non-traditional banks. And they enacted those laws, so went into effect in December. So now, if anyone tries to lend within California, within these industries, they have to have that disclosure before you sign docs. So you'll be, become very aware of what the cost of the money is, where most small businesses really had no idea what they were getting into. They were just looking for a lifeline. And I get it. And there's a place for that if that's where you have to go and you can get out of it. But most of the businesses don't understand how it's going to affect their cash flow. I have a lot of SBDC referrals and they're stuck with these people. And my job's to pay them off, get rid of them. So that's sort of an explanation.
Fantastic. Thanks, Andrew. And I saw a lot of head nods because I'm sure every single one of our lenders, and I know us at the SBDC have tried, worked with some businesses that get trapped in that addiction cycle, like you said. And I think that's appropriate. And that was a really good explanation. In short, if it sounds too good to be true, it is. As you learned about some of the processes, while they are straightforward and simple, but what you've heard from, I think, all of these folks is you want to be able to talk to a person via Zoom, on the phone, in person, what have you, because then you're going to have that relationship with that lender. And I think those are some of the key things to be able to avoid. All right, let's turn to something fun and positive. Always my favorite part is a success case of a recent client that you've been able to help. Feel free to anonymize it as much as you want or as little as you want. And but just kind of, a small business that you've been able to help recently be able to, get finance, grow their business, something like that. Because I know that's why we all like to help small businesses. Pete, why don't we start with you?
Yeah, so I just recently had one. It was a personal client of ours who was looking to purchase a franchise, a trash compacting franchise, him and his partner. And I mean, they were just looking everywhere, I guess, to get financing and just weren't given any options, especially because it's a brand new business. You know, after sitting down with him and doing a tax analysis with him, you know, him and his partner, and kind of looking at just the strengths of them personally, you know, we were able to come up with a game plan to get financing, which ultimately we did. We got approved. And, you know, we talked earlier about, you know, guarantees. That was something that we were able to do and use the SBA Express, which guarantees at least 50% of the loan. And that was to help mitigate for, you know, maybe some lack of collateral, newness of business, you know, but with the secondary income that they had, and, you know, at least the projections that they're able to provide, and the business having some element of, you know, machinery, you know, the UCC obviously makes sense. It has some weight behind it. So, you know, they ended up coming to us trying to get, you know, personal loans and max out, you know, the equity in their homes. Whereas, like, no, we were able to kind of simplify and put it into a business loan that worked for them and allowed them to get their business. And they were just like, man, like, how come no one else at least talked with us about that, you know? And because it's new, we didn't even think that that was an option. So that was a great success story that we're able to do and help these guys get their business.
Fantastic. Fernando.
Yeah, we recently funded a hot sauce company. We've actually had a lot of success in the food and beverage or consumer packaged goods industry here lately. And we had a hot sauce company that was working, that had come to us earlier last year, tried to get funding, ended up going with another lender, and then came back to us late last year saying, yeah, you know, it's not working out. And we were able to switch them over and are really a better fit for their growth. Now they're, you know, they've just got a contract to go into Walmart, which is huge for them. So that's going to really create some exponential growth opportunity for them. And we're in the process right now of starting to ramp up their inventory for some of these Walmart POs that are going to start coming in soon. So so that was a great one. And, you know, we hope to see them. Their goal is to get acquired here at some point. So hope to see them grow and help them achieve that goal.
Fantastic. Juliet.
Sorry, I got stuck in the chat. Fernando, I'm so glad that you're able to help that guy. That's awesome. I also talked to him, if it's the same guy I'm thinking of. Recently, we were able to fund a juice bar, and I was really excited about this client because I actually worked with the SBDC, and they just wanted a little bit of capital. So what happened is he had a partner who started the business with him, and his partner actually pulled out. And so they ended up closing in December, and they're located in La Jolla, just off of Prospect Street. So if you guys are familiar with the area, it's very high foot traffic area, lots of very small businesses. So easy to just, you know, walk by and step in for a quick juice. And he closed during December, and then he reopened the beginning of this year, and he just needed a little bit of capital to hire an employee so that he could, you know, take some time and not be there 24/7. So we were able to just give him a small $15,000 loan, and it was a great example of the relationship with the SBDC that we have, because he was working with one of the mentors who then referred him to me, and then we were able to get him the funding. So we were really happy about that. And, you know, happy that the spring, well, hopefully the weather improves soon, but the spring and summer are upon us, and, you know, the foot traffic is only going to increase in that area. So we're really excited for him as he grows his business, getting into the warmer months.
Awesome. Andrew.
Yeah, I sort of talked about it earlier. So did an event that had a small business come up to me. So they started in revenue about I think it was June or July last year, and him and his partner, who had worked for different companies, were in the underground utility and cell tower business. He wanted to go out on his own. He had contacts, he had people, he had skill set, so he took his own money that he had and he threw it at it, and they went after contracts, started their own company, basically focusing on cell towers repairing them, replacing them, putting up new ones, moving them, anything the industry needs, which, if you watch all the cell ads, there's a lot of that going on within the industry of people, competing for your cell phone coverage and stuff like that. And, that's a big thing to say you have coverage everywhere. So they're swamped at that end. And so they started out, they've grown it to about 700,000 revenue. They walked into their local banks and the banks weren't able to help them because they were brand new. And they didn't want to go the SBA route because there wouldn't be enough cash for them. And they didn't have enough collateral to do that. And they saw me speak, came up, and we're going to actually sign them up, next week. And they're telling me they can go from 700,000 to this year 2 to 3 million. So that is really incredible growth. And the best part about their business, they can bill daily, they can bill weekly, no retention, no union. And most of their jobs are done in 30 days or less. So I can fund him every day if he needs money every day to get from point A to point B. So it's going to be really exciting for him and his family and his partner. It's going to be a very good growing business. It's going to create a lot of jobs. And the city where I did the presentation is excited that they rent space from the city and it helps the city with their jobs and growth in their community. So it was a win-win for everyone. It's pretty good.
Awesome. And Janelle.
We had a client, as a long-term client of mine, is a family-owned Mexican restaurant. They were looking to expand into a new location. So I was able to get them financing to move to a new location, help with tenant improvements. We were able to do an SBA Express loan. So we did have the guarantee because, the restaurant business, but we were able to get them the terms and the loan pretty quickly. They were able to open a Mexican food restaurant, which there can never be too many Mexican food restaurants. So I was happy to see that. But it was a great success story. And they've come back again for additional financing because the family business is continuing to grow and expand.
Fantastic. I agree with you. There can't be too many. So real quick, as we wrap up, I just want to go around the horn one last time with one quick tip each of you have, as we have 5 minutes left here. One tip you'd give small businesses as they're seeking capital. And why don't we start with you, Andrew? Your quick tip.
All right. Quick tip. I think it's very obvious if you're on this call with us, get to know your local SBDC. I mean, to get all the services they offer, they have 100 people that are in there with different expertise and it's all free. Why wouldn't you go in there? I push a lot of my clients into that direction. Some of them go, some of them don't. I have no idea why they wouldn't take advantage of this. Nobody knows everything about business. Not me, nobody on this panel. We all have expertise in various categories. And when you have a strong SBDC that has 100 consultants, you have to go for it. You have to do it in small business today. You have to have people you can trust and help you out. The second thing I would say is, really make sure you understand how to read your financials. There are a lot of young businesses that hire bookkeepers who don't know what they're doing. You may think they do because you don't know how to analyze it, but you really want to talk to your CPA. If you produce numbers with a bookkeeper or somebody you found just somewhere, in the yellow pages, you want to bring it into your local CPA to show them your numbers, spend the money to have that one call and just see if they're setting everything up right. Because as lenders, the first thing we do is, we talk, we can figure it out, but we still have to get your numbers. And that's when we see everything that's being done right or wrong. A classic example is, somebody has idle and they put it down as equity on the balance sheet. It's not equity. It's other income and it shows up as income, and that's the way it should be. And I can't tell you how many times I've seen that. So you really want to make sure you have a CPA that you trust, not somebody who's just a bookkeeping, but a CPA, where if you have someone doing your numbers, bring them in and just double check that everything is classified, looks right. And that will give you peace of mind. So when you come to us as lenders, or for money from us as lenders, we can really give you very good feedback and very quickly. We know what you're doing. We like that when we make presentations to our credit committees and so forth and so on. And it will help you get the money you need a lot faster. And you'll know how to run your business, that you have accurate numbers, which is critical to success and surviving.
Thanks, Andrew. And Pete, what about you? What's a quick tip you would give?
I also agree. SBDC would be the first thing you want to go to. But I would say understand your big picture. I think a lot of times people come into the bank or a lender or any financier that they're going to talk to and just ask for money for the sake of it. I just want $100,000, you know, don't really need much of it. It's like, no, like understand the big picture of what you're trying to do and what that money is going to accomplish. You know, one of the things that underwriters are going to want to understand is the borrowing cause make sense, you know, and what is this money going to do for you? You know, those are kind of things that you, as a lender, I want to be able to provide the picture to our underwriter. So if you're saying, hey, I want to borrow $100,000, it's one thing to just borrow the money, but it's another thing when I can say, hey, underwriter, because I do talk with them, you know, this $100,000 that we're going to give the client is going to help them to be able to double their business. You know, so that's a point that I could be able to present. That's a strong compensating factor because them getting this money is going to increase the revenue. So understand why you need the funds and really paint that picture to your lender and just be, again, very honest, very upfront. We all can talk about our strengths, but a lot of times we do shy about our weaknesses. Be very upfront with them because the more we know, the more we can work with you and get that, you know, get that stuff taken care of upfront as opposed to backpedaling at the end. So that would be my tip.
Thanks, Pete. Fernando, what about you? What's a quick tip you got?
You know, using the right financing vehicle, I think is very important, right? So we've heard a lot of, you know, different products thrown around here today, and it's really important that you tie the correct facility type to the correct need, right? There's a term in banking you hear called sources and uses. And so you want to make sure that if it's a short-term expense, you're using a short-term financing product. If it's a long-term expense, you get a longer amortized loan that's going to, you know, extend that out over a few years over the life of that particular venture or product or equipment or whatever that is, right? So that's where I see a lot of businesses getting into trouble is they go out and they just get whatever quick money or whatever they think, you know, is maybe the best product or the easiest, right? And then ultimately they're having to go and refinance that debt later because it wasn't, you know, it wasn't used for the right purpose, and now they're, you know, they have just more debt that they're dealing with. And we're seeing a lot of companies, you know, quite frankly, that are over leveraged right now. They just have so much debt on the books, and it's because they've, you know, taken a bunch of loans that they just want to, you know, kind of tread water, and now they feel like they're in a position where they want to expand or they want to do more, and now it's harder to actually bring on debt for the right reasons. So just make sure you're using it. You're using the money, you know, the right product for what you're going to use it for.
Fantastic. That makes a lot of sense. What about you, Janelle? What's a quick tip you've got?
I think for me, the most important thing is be honest and upfront about everything that you're trying to do. It's really frustrating working on a loan for somebody and not really understanding what the need is and to understand, you know, the past history. So, you know, you need to make sure you're upfront because we will find out, you know, about, you know, that bankruptcy you had, you know, 7 years ago that you think is off your credit. If you can let us know about it, we can, you know, include that in the write-up. And it goes to character because if we feel that you're hiding something from us, it puts a question mark in our mind. You know, what else is there in the past that you're not disclosing? So I think just a full and complete conversation about what you're doing, what you're trying to do, you know, what's happened in the past so that we can make sure that we can explain and talk to the underwriter and tell your story accurately to get you the best chance at getting a loan.
Thanks, Janelle. That's really good. And Juliet, you get the last word. What's your tip?
I'll keep it quick. I want to echo what Andrew said, you know, utilize the SBDC. I send people every single day to work with a business mentor on a business plan and financial projections, since that's what we need for our startup businesses. And then my quick other tip would be to separate your personal from your business bank accounts. That's something I see a lot, lots of commingling going on. So just make sure to separate them. Fantastic.
Well, thanks again to our panel, Andrew, Pete, Fernando, Janelle, Juliet, and everybody. You have a fantastic weekend. And again, SBDC Day is March 15th. We're happy to celebrate. Really what it is a celebration of small business. So you all take care and have a fantastic weekend. Thank you.
Bye-bye, everyone. Stay dry.